Thought we'd talk to you today about China manufacturing and U.S. manufacturing and a comparison of the two and the cost of each. At Crown Capital, we're very focused on industrial companies, industrial services, industrial production, manufacturing, fabrication, because we think we're going to have about a 10 to 15 year tailwind pushing work into the United States. And just as a baseline for that information, 2005, which was an up year for manufacturing in the United States, manufacturing and industrialization produced $1.88 trillion contribution to GDP. 2018, it was 13% greater, $2.13 trillion of contribution to GDP. That is faster growth than actual GDP. So you can see this tailwind just starting to take hold. Now, why it's taking hold is kind of best represented by the Graniteville facility. When we first transacted on Graniteville, we asked them why they even exist. Why isn't China doing all this work? And it turns out that out of the 100% of work that they used to do in the 60s and 70s, they kept 30%. Why? Because that work was very hard to reproduce offshore. It was higher end, custom, a lot of R&D, very proprietary and collaborative with the customer. So very hard to reproduce that. The truth is that probably 10% of the work below that was also difficult to move offshore, but was marginally advantaged to move offshore. So it moved, right? And it moved downhill really primarily based on the cost of labor. It moves to China. Now, China then becomes more and more industrialized and moves from a third world economy to a first world economy. And as that happens, this 10 to 15% of higher end collaborative production work becomes less and less productive to produce offshore. So there is some entrenchment that happens initially, but as the cost continues to rise, that work starts to come back to the United States. Now why? Look at these total cost of production analysis as advised by BCG. So Boston Consulting Group in 2014 suggested there was only a 5% difference overall between U.S. cost of manufacturing and Chinese. That has since changed. So Chinese costs are even more accelerated. So in particular, the rate of labor. Since 2005, there's been a 187% increase in the cost of Chinese labor. Since 2010 alone, there's been a 121% increase. Just imagine how that changes the math on all these. So people assume that China is cheaper. It turns out that today, Indonesia is the cheapest production facility in the world. Worker productivity. Well, on a productivity basis, U.S. workers' productivity per worker increased 22% since 2006. 22%, that's a dramatic increase, while the other costs of producing offshore are rising dramatically. These you can kind of group together. Moving from third world into first world requires a lot of regulatory change, and regulatory change creates an uncertain market that changes energy costs and raw material costs. An example is in coal in 2018. Coal in 2018 jumped 50% because China came out and required a 16% shutdown of production in their coal facilities. So that jumped prices 50%. And then, of course, the normal suspects, transit costs, logistics risks, containers falling off ships, etc., damage to supply chain, time to market, a lot longer if you're working with an offshore supplier and delays in that supply chain, and then also, again, this design thinking, this collaboration with the local producers. So it's time to rethink our products and rethink where we build them. It might take some reinvestment in U.S. capital structures, but the time has probably come to make that effort.